Actually, yeah, good. Yeah, we did hold the session. This.
What does it say? Powerful of dreaming? Hey, a couple of things before I start. One is obviously a reminder that the third quiz is Monday, 3:30 to 4. If you are Jewish, I know sundown that day is when Passover begins. So if you need to take it early, you can take it with my MBA class. It'll be a different quiz, obviously, from 1:30 to 2. So I'm going to give you that choice if you want to take it earlier. So let me know if you are. The other thing is actually related to the final exam. As you know, the final exam is May 13th from 3 to 4:50, right? It's not, I think 3 to 4:50. It's an hour and 50 minutes. Don't ask me why. I know that early in the class, I talked about my MBAs having an exam on May 8th and that I might be able to get some of you into that exam. The problem I'm having is my MBA class exam is going to be in KMEC 170, which fits 130 people, and my MBA class is 127 people, which means there's not much extra seats. I am trying to get an extra room for that day so I can split people off. The only problem is final exams week, rooms start to get booked for strange reasons. Let's say private booking. I don't know what that means. So I've asked them to give me a room on that day from 1:30 to 3:30. If that happens, I will open up a Google shared spreadsheet for those of you who want to take the final exam on May 8th rather than 13th. Right? My advice to you is if you can take it on the 13th, you have the luxury of time. The project comes to you on May 6th. You get time to prepare. But if for whatever reason you feel you have to get your stuff done and maybe you have to travel that weekend, wedding to go to, whatever it is, I will set up it, but only if I can get the room. So wait for the sequence, and if it happens, I'll let you know. So today I'm going to start off because Deep has an announcement. I'm going to let him make the announcement, and then we will start with class.
Hey everyone. Just a reminder that tomorrow we're going to host a review session, same time, 11 a.m. to 12:15, UC 25. And the quiz is on Monday. So if you guys want to show up, get some preparation for the quiz, me and Jake will be doing our utmost. That's it.
And Deep and Jake are going to buy pizza and I'm just kidding. So let's talk about private company valuation. Today, we're going to start by looking at what makes private company valuation a little different. And we started on this discussion already. So I'm going to start with some basic questions about private company valuation that are going to set the table. Let's say you have two companies. They look exactly the same. One is a publicly traded company and the other is a privately owned business. And you're estimating the cost of equity for the company, right? Risk-free rate, beta, risk premium. Just give me a sense of direction. Will the private company have a higher cost of equity? The public company have what do you think? Okay, so everybody get that? It's a lack of diversification means you see all of the risk. You're going to demand a higher discount rate because you see all of the risk. Private company buyers who are not diversified will demand a higher cost of equity because of lack of diversification. The other thing we talked about was liquidity, right? That when you buy a private business, you are more illiquid. It's much more difficult to reverse your position and you attach an illiquidity discount. And I mentioned that the standard practice that appraisers use is to attach a constant, minus 25% for every company. And I've never quite understood why you get away with it. And to set up that discussion, we'll talk more about it. Let me give you 4 companies, and you tell me in terms of discount whether you'd expect the just purely liquidity now, whether the discount should be different. So the first contrast is profitable versus unprofitable. Let me pause right there. Which of those two companies would you have a bigger discount? Unprofitable companies or profitable companies? We're wrong. Unprofitable companies are a bigger discount. Tell me why. Yeah, risky will show up in a discount rate. It's not risk. I want you to focus just on liquidity. When you have a profitable company, you get cash flows every year, right? It's like you get partial liquidity without even selling the company. So when you have a money-making company, you get some liquidity without ever selling the company. But when you have a money-losing company, you don't have that. So I would expect the discount to be lower for money-making companies and money-losing companies. Should the discount be different for different buyers? So let's suppose, now let's say you're a long-term buyer and he is a cash-constrained buyer. You're both looking at the same company. Should the discount be greater for you or for him? You're long-term, he's cash-constrained. It's going to be greater for him because he needs the cash in a hurry. So you'd expect discounts to vary across. Did I get the wrong thing? So, are you crying or no? Okay. So you'd expect the discounts to vary depending on profitability, vary across companies, vary across buyers. Might it vary across time? Let's say you're trying to sell a private business, November of 2008, peak crisis time, as opposed to 5 years later, things have settled in. You'd expect the discount to be greater or lower during a crisis time. During crisis, what does everybody want? They want liquidity. They want their cash now. The discount should be much greater. Already you can see my setting up a counter to the standard practice. When you use a 25% discount for every company and every buyer and across time, I don't understand how you get away with it, because I'd expect the discount to vary across companies, vary across buyers, and vary across time. The defense, of course, appraisers give is how the heck are we going to do that? Let's talk about processes by which we can estimate discounts that vary across companies, buyers, and time. One final point. So you talked about diversification and how it affects your cost of equity, and liquidity and how it leads you to pay less for a company. Let's say you own a private business. You want to sell the business. You want to get the highest price you can, right? So I'm going to give you 3 potential buyers, and you tell me which one of them is most likely to pay you the highest price. They're looking at the same company, same financials. The first company is a private owner. Somebody wants to buy a business because they're like you. They want to run the business. The second is a private equity fund. They're going to buy your business as part of a fund. And the third is a publicly traded company. Which of these 3 is going to offer you the highest possible price? Max, you want to try? Who's going? A private owner, remember, the price is going to be determined by how much risk you see in the company and whether you care about the liquidity. You're a private owner, so you're going to see more risk, which means you're going to put a lower value in the company, right? And then you knock off another bit, you're going to offer me the lowest of the 3 prices. I want the highest of the 3. So which of the 3 you think suffers least from those problems? And what is it about the publicly traded company that lead them to pay more? Whose money are they investing? Investors' money. And what are those investors? Blackstone, BlackRock, Vanguard, diversified investors. So they're going to not demand a higher cost of equity. They see them. And what happens to this company once it becomes part of that publicly traded company? People want liquidity. What do? They just sell the shares, right? Liquidity in a public company comes from being able to buy and sell the shares. So you don't care about diversification. You don't care about the liquidity. It means a publicly traded company is going to offer a much higher price. It's actually a pretty depressing thought, because it means over time, you know what's going to happen to private businesses. They will become increasingly taken over, replaced by public companies. Any of you been in a pharmacy recently? Don't tell me you have COVID and you're sitting in the front row. I mean, you've been in a pharmacy. Right? 40 years ago, if you walked into a pharmacy, the owner of the pharmacy was usually behind the counter. Most pharmacies in the US used to be privately owned, with the pharmacist owning it. I'll challenge you to find me a privately owned pharmacy in New York City. You walk down to Broadway, you hit Duane Reade. You walk in the other direction, you hit CVS. Increasingly, pharmacies are publicly traded. They've driven out the private owners. Before Blockbuster Video, you probably don't even remember Blockbuster Video because none of you is old enough to remember when you had to actually go in and rent a video. But Blockbuster Video was created by rolling up private video rental stores around the country. It's called a roll-up. In fact, that's the way that these companies are created. And in business after business, this is inexorable. Public companies are going to drive out private businesses, not because they're more efficient, but because the diversification that they bring to the game allows them to take risk more efficiently. So let's talk about these more because they're at the heart of what we're going to talk about today. Let's go back to where we were, the slide that I left with, which is the last slide. So I want to review the slide. Okay. So I talked about a company where I said it has non-diversifiable market risk and diversifiable risk. I said when you use a beta, which is what we've been doing all the way through, we're focusing only on the non-diversifiable risk. And our defense is investors can diversify away the rest of the risk. We're not going to bring it into the cost of equity. And if you're valuing a Shopify, you're going to value a Facebook or NVIDIA, it stands up, right? Publicly traded companies with investors who are diversified. With a private business where the owner is completely undiversified, this game gets blown up. You can no longer just say only the market risk matters. You got to bring in the rest of the risk. You're saying, how the heck am I going to do that? Unfortunately, the data we have is on publicly traded companies, but there are clues in that data. The beta that you get from a Bloomberg regression captures the market risk. So let's say I have 50 companies. Now I'm looking at a privately owned restaurant. I have 50 companies. I get all their betas. I average the betas. I get a beta for being in the restaurant business. But in the same regressions, I also get an R squared and an R, which tells me the percentage of risk in these companies that comes from the market. I get that for all 50. I average it out. I now have the pieces in place to be able to tell you not just what the beta is for a diversified investor, but what an undiversified investor can face, because that beta with the correlation allows me to come up with what I call a total beta. So let me be explicit about what those numbers look like. Remember, I was valuing a restaurant for an investment banker, and I told you my publicly traded companies were going to be high-end retailers. The average unlevered beta for those retailers was 1.18. So if this had been a publicly traded restaurant, I'd have taken that unlevered beta and played a little game. But I can't go there yet because the owner here is going to be, the buyer here is going to be completely undiversified. Turns out that the average R squared across high-end retailers is about 25% or 0.25, which gives me an average correlation of 0.5. It's one of those places where you got to be careful. You take the square root of a decimal, the square root is actually going to be higher than the number you're taking the square root of. So the typical high-end retailer, half their risk comes from the market, and the beta 1.18 measures it. You're completely undiversified. You see all of the risk. Guess what you're going to think of as your beta? It's not going to be the 1.18. It's going to be twice that number. It's the market beta divided by the correlation. What if only 40% of the risk came from the market? You divide 1.18 by 0.4. If only a third of the risk comes from the market, the less correlation there is, the higher the total beta will be, because there's more firm-specific risk to bring in. Higher beta is going to play out as a higher cost of equity. But before I go there, this is an unlevered beta, right? To get to a levered beta, I need a debt-to-equity ratio. Debt-to-equity ratio has to be a market debt-to-equity ratio. And I'm running into another brick wall with a private business. I can get debt, but there is no market equity. You're saying I can use book? Never use book equity. It's a non-starter in this game. There are two choices you have to get a market debt-to-equity for a private company. One is you can assume that the debt-to-equity of publicly traded companies that you can observe is what this private company will also have to face, because it comes from the business you have. You're a retailer. It's not like you reinvent your business model as a private company. You still have to pay for the lease. So that's an easy choice, is to go with the debt-to-equity ratio for the industry. And that's what I used here, as I used the 14.33% average debt-to-equity ratio to come up with the levered beta. So the 2.36 becomes 2.56. So expect to see much higher betas with total betas because it's magnified to capture the rest of the risk. That's one choice. There's another one that's requires a little creative excelling. When you do a discounted cash flow valuation, what do? You take the debt to equity ratio, come up with a levered beta, get a cost of equity, you get a cost of capital, and use the cost of capital to value the company, subtract our debt, and you get a value for the equity, right? What if I let you use your estimated value of equity in your debt to equity ratio? Tell me the mechanical problem you see with that. What's the challenge you face when you try to use your estimated value of equity as the debt to equity ratio? Because there's a circularity, right? To get the value of equity, I needed a firm value. To get the firm value, I needed a cost of capital. To get the cost of capital, I needed a cost of equity. To get the cost of equity, I need debt to equity ratio. So you're saying it's like the chicken and the egg problem, right? Without the debt to equity, I can't get the equity without but there is a solution to that, Nixa. If you go to the calculation options, there's an iteration box. You check the iteration box off. It'll allow you to use your estimated value of equity in the debt to equity ratio. It's actually I think, a more complete solution for private companies because it means you're not trusting the industry average from publicly traded companies. You're using your own estimated value of equity in your debt to equity ratio. But at the end of the process, no matter what you do, you're going to end up with a much higher cost of equity for a private business because you start with a higher beta. Any questions in the mechanics? Yes, Sebastian. That might. I mean, I don't think it's a larger and more mature. They might have more access to capital than you do. So from that perspective, the second approach might work better. The business like retailing, though, or in restaurants, it's not going to be that different. The restaurant business model, whether you're 1 or 50, is basically the same model. Each restaurant carries its own leases. So in this case, it probably would make a difference. But if you're a tech company or you're a consumer product company, the second approach will work better, but just make sure you check the iteration box before you do it. Otherwise, Excel will go crazy on you. The lines will start to go zigzagging across and all hell will break loose. Now, to get the cost of debt, I followed a more conventional route. I initially went and looked at Moody's to see if they had a rating for this restaurant. And guess what? There is none. You kind of expect that. And small private business don't get rated. But remember what we did for publicly traded companies when you did not have a rating? We estimated a synthetic rating based on what? An interest coverage ratio. EBIT divided by interest expense. I can do that for public and private companies. And in this case, that interest coverage ratio is 3.33. You convert that interest coverage ratio into rating, I get a double B plus rating. A double B plus rating gives me a default spread of 3.25%. I'm home free. I've got a cost of debt for a private company. So cost of equity, I use a total beta. A cost of debt, I use a synthetic rating. I take a weighted average. My cost of capital to this buyer who's undiversified is 13.25%. So that is my first stop, is getting a discount rate, a little more involved than in a publicly traded company, but we're not throwing first principles out. We're just adjusting those first principles for the fact that investors are not diversified. Okay. Second stop, I have to clean up the income statement. Remember the two things I had to clean up for. One is in 2013 or 14, when I did this, private companies and public companies were treating operating lease expenses as operating expenses. I capitalized those and said, those are really financial expenses. So remember that present value of lease commitments and converting. So I made that adjustment. That's a pretty conventional adjustment. I'd have made it for a public restaurant company as well. The second adjustment was that I'm going to buy a restaurant with a named French chef. And what did I say about myself as a banker? I can't even scramble eggs. If I buy this restaurant and the day after the chef, remember the chef is going to sell the restaurant and leave, and I'm in the kitchen, the menu is going to have only one item. Scrambled eggs, really well done. That's it, right? This restaurant is not going to last very long, so I've got to go hire somebody who can actually cook. So I go looking for another French chef. You're saying, why don't you just walk into McDonald's, pull somebody off the... I could, but the menu would not look like a French restaurant menu, and it's going to be pretty expensive, $150,000 a year. I'm trying to replace the chef. You see already what that's going to do, right? I'm introducing an expense I will have It's going to lower my earnings. My operating income after those two adjustments works out to be $370,000. So I've taken the financials, I've cleaned up for the fact that the owner was not paying himself a salary, and now I have an adjusted operating income. So I hire the chef. I open the restaurant. What did I say about this restaurant? It's pretty much at full capacity, I said, right? But that full capacity comes from the fact that I have this named chef, people who know, and people are coming to the restaurant because of me. Even if I hire another French chef, I don't think they're interchangeable, right? You can't hire somebody. I've a big name chef. He's replaced Gordon Ramsay. My guess is a Gordon Ramsay name carries some weight still. So my next stop is to adjust my value for the loss of a key person. It's called a key person discount. I would love to tell you that I have a template for calculating this, but what are you trying to estimate? If I become the owner of the restaurant tomorrow and I've hired a French chef who's not the name chef, how many of my customers will stop coming and how much less will my revenues be? No. And this can be a pretty big hit, especially in businesses that involve some personal relationship. I'll give you a very personal example. 4 kids, thank God they're all grown up now, so I don't have to worry about their teeth, but they all had braces. I never had braces. I didn't realize how much of a continuing business this was for dentists. I thought you put braces on, then you forgot about it for like 8 years and they just fell out of your mouth. It turns out that that's not true. You get braces and you got to go in every month and they finesse the braces. They I think they do it deliberately. They tighten it too much, so you have to come back sooner. No. So my kid's dentist was this child's orthodontist. His name was Howie. So I'd show up in Howie's office every month with my 4 kids, and they'd all get their braces, just look like an hour. And Howie would chat about markets and stocks. For some reason, he was fascinated with markets. And I had to go along. My kids are under the, this tremendous, potential for torture here if I don't behave myself. So I take my kids in one and he says, can I ask you a question? And he takes me into the office and I thought he was going to talk about my kids' teeth. And he says, I'm thinking of retiring. And I said, how are you, like 40 years old? He said, I've made a lot of money. I said, I know. I've been checking my credit cards every month, right? So lots of people like me come through. And he said, I'm trying to sell the business, but the offers I'm getting don't reflect how much money I'm making on the business. And I said, Howie, that's easy to explain. If you're a new dentist buying the business, you see why you're not going to pay what Howie shows as income, right? Because can you imagine me coming back next month and Howie's gone and you're the new dentist? And I said, who the hell are you? And he said, I'm your new dentist. I said, no, you're not. I've seen the marathon, man, and you look a lot like the person who's torturing people there. This is a personal service. And person buying it has to factor in a key person discount. So I explained it to him and he said, is there something I can do to kind of reduce that discount? And you could probably tell him what he needed to do because I told him exactly what I thought he needed to do. What advice would you give Howie to reduce that discount? Sebastian? Yeah, that's not going to be enough though, because then he's going to be gone. See, but that's a financial solution, right? This has got to be an operating solution. I need those people coming in month after month after month. I said, how you got to stay on a couple of years? I said, get a massage chair, sit in the chair. You don't even have to do any dental work anymore. And when your clients, customers like me come in, now walk me over to the new dentist and now stand around looking like you're overseeing it and say, that's a great job, amazing job, He wasn't happy about the fact that it delays retirement 2 years. But if in return, you could reduce the discount from 50% to 20%, that was a fair enough. He ended up staying for 2 years. I saw how he for now. So when I came after that, he'd be just sitting around doing nothing in the massage chair. I tried to get him to get a second massage chair so I could sit next to him in a massage chair. But I had to sit in a wooden chair. He sat in a massage chair. But we had our, key person discount. In this case, I knocked off 20% of the value, which basically is going to make the 317 to 296,000. Yes. You could, right? But in a sense, this is your business. You don't want to be an underling. You basically want to collect your money. You don't want to do any work anymore, basically. And if you get paid a salary, you are expected to do stuff, right? So I think he was okay, not get, as long as he got the upfront 30% more, that's a lot of money upfront. He was willing to essentially lend himself as a figurehead. Um, so, yeah. Next up, don't forget your valuation fundamentals. Just because you're valuing a private company doesn't mean all the things we talked about already get forgotten. Like what? To grow, what do you have to do? You got to reinvest. How much do you have to reinvest? Depends on what return on capital you expect to make. In this case, I'm going to keep things simple. And I'm going to assume that if you buy this company, if you buy this restaurant, your growth rate is going to be roughly the inflation rate. And the reason I'm doing that is actually tied to what I told you about the restaurant at the start of this process. What did I say about the restaurant? It's at full capacity. So unless you can figure out creative ways of getting more than full capacity, maybe remember restaurants work on seatings, right? And there are restaurants that actually make seatings shorter to have more seatings. So assuming that that's already been tapped out, you can grow. Saying, what if I build an extension to the restaurant? You could, but then I'm going to ask for capital expenditures, right? So in this case, I'm going to keep the growth rate at the inflation rate and estimate how much they will have to reinvest. They have a return on capital of roughly 20% that came out of the company's the restaurant's financials. Basically, they'll have to reinvest about 10% of their after-tax operating income. You might ask, if they're full capacity, what are they reinvesting in? Replacing that old stove in your kitchen with a new stove will cost you more if there's inflation. I'm factoring that in the reinvestment. So maintaining capacity requires reinvestment. We're almost there because now I have everything I need. I have the adjusted EBIT, adjusted for the key person leaving. I have a tax rate of 40%. Why 40%? Because this restaurant was going to be privately owned. It was not incorporated. So you don't pay a corporate tax rate. The owner would be paying personal taxes in New York. And I'm probably being too generous in setting the tax rate only 40%. Probably more likely to be 53% by the time you're done. But let's leave it at 40%. Growth rate of 2% and a reinvestment rate of 10%. Just a traditional mature company valuation. There's one thing that I considered doing that I should probably have done. What am I assuming when I do this? The restaurant will last for how long? Forever, right? And with private businesses, there might be a trigger point at which the restaurant will cease to exist. And one of the trigger points is when leases come due. Why? Because the owners will often raise the price. So let's say there was 22 years left on the lease. It was a really long-term lease. Instead of using a perpetuity, what could you have done instead? Nick? If you had 22 years left after, in terms of the lease. Just do a growing annuity for 22 years, you're done, right? There's after year 22, there's nothing, no liquidation. What are you going to do with the kitchen equipment anyway? So I could have done that if I felt that this could not be renewed. So with private businesses, exploit every flexibility that discounted cash flow models give you. So now we're ready to attach this illiquidity discount. I told you the standard practice is 25% of everything. I'll show you where that practice came from. But I think it's bad practice. Why is it bad practice? Because I'd expect the discount to vary across companies. Money-making companies should have smaller discounts than money-losing companies. Small companies should have bigger discounts than larger companies. Yes.
But also a point where like the private companies just boom and then
They could go public, right? So in a sense, that's a different game. We'll talk about what you have to do to your discount rates if that's your end game. Right? So it's going to be true for a subset of companies, not even success that drives it. It's what kind of business are you in? Can you scale up enough to go public? We'll talk about what that outcome will look like if that is your end game, not the end game of staying a private to private transaction. So I'd expect the discount to vary across companies. I'd expect the discount to vary across buyers, long-term versus cash constrained. I'd expect the discount to vary across time. So let me start by explaining where that 25% discount you see in private company appraisal. It's almost hard-coded into spreadsheets comes from. It comes from two sets of studies. Remember, to observe what investors are charging as a discount for illiquidity, you need to be able to observe the price without the illiquidity and the price with the illiquidity, right? So when you look at just private company transactions, it's tough to tell how much was illiquidity because all you observe is the price. So both these approaches, here's what you're going to see enter the game. A market price you can compare the illiquid price to. The first is a subset of companies that are issuing what are called restricted stock. Normally, when you're a company wanting to raise capital by issuing shares, you issue shares at the prevailing market price or slightly at a discount because you need to raise capital. But with restricted stock, you issue shares, but those shares come with a catch, which is the people buying these shares are not allowed to trade the shares for 2 years after they get the shares. Okay? So let's play a game. Let's assume that I decide to issue restricted shares to Nick. Right? My stock price is now 10. I issue 10 million shares to you. And as a catch, I say, look, once you get the 10 million shares, you can't trade them for 2 years. Will you be willing to pay the $10 price that you see in the market for those shares? Will you pay less or more? How much less? Depends on how much you care about the liquidity, right? The more you care about the liquidity, the lower the price will be. And I can observe it because restricted stock issues are in the public market. So let's suppose you bought the shares at 8. The market price is 10, you bought them at 8. The difference is the discount. And so restricted stock studies take the subset of companies that issue restricted shares and compare and look at the discounts. Many of them look at the median discount, which has always struck me as strange, that you just take the median, throw the rest of the data out. That median discount was about 25, 30, maybe even 35%. That's a first set of studies. The second set of studies look at IPOs, companies that go public. But rather than focus on the offering price, they look at transactions that happen before the public offering. So they've announced they're going to go public in 6 months. But there are VCs who sell their stakes to each other before they go public. They look at the price that those VCs get for those transactions relative to the actual offering price, arguing that if you're selling 2 months before the offering, you have illiquidity and you have to sell at a lower price. They observe that discount. In both cases, those discounts become the basis for what private company appraisers use in practice. Now, before we look at the incentives that private company appraisers have on that discount, remember we talked about bias very early in this class? Do private company appraisers have a bias when they value companies? What kind of bias will there be? If I have 80% of private company valuations are for divorce court or tax court, right? So so if I am the owner and I come to you, do you want a low number or a high number? I live in a community property state, which means half of whatever I estimate I'm worth has to be paid out. And if I want to minimize that payout, I want to tell you my business is worth nothing. So there's an incentive here to get the biggest discounts you can. And historically in private company appraisal, they've latched onto these discounts because they're big, 25, 30, 35%. Imagine having a $10 million business and I knock off 2.5 million, saying, you say, why did you knock it off? It's a illiquidity discount. You're going to be probably pretty pissed off, right? It's like an automatic number that comes out of nowhere. So here's what we're going to talk about. We're going to talk about why people got away with it for so long, what the pushback has been, and how even with those discounts, maybe we can have some nuance. So even if you go the restricted stock route, why using just the median makes no sense at all. So until the first restricted stock studies came out in the early 80s, for the first decade, there was no pushback at all. So the way this would play out is you go to tax court, the appraiser for the private business would take the 10 million, knock off 25%. When the judge asked, what are you doing? He'd say, this is a standard illiquidity discount. And the IRS would collect a lot less in taxes, or your spouse got a lot less of your business, and nobody pushed back. Until about almost 20 years ago, the IRS finally decides to stop being cheap, and I've actually hired somebody to look at that restricted stock discount, because it turns out that 35% might be the median, but there are differences across companies which do restricted stock. Some have discounts of 15, some have discounts of 50. Nobody seemed to be curious about why is that discount different across. I don't know whether you've heard of Bill Silber. Bill used to teach foundations of finance. He's a legendary professor at Stern. He just retired a few years ago. He used to teach the foundations class, and then I teach the corporate finance class right after him. But Bill laughs because in the 40 years he did research and he wrote books. There's one paper he wrote on restricted stock, which was like a throwaway paper that turned out to be his most quoted paper of all time. And here's what he did. He took those companies that had restricted stock issues. He took each company's discount, but then he took an extra step. He asked, why are the discounts higher for some companies and lower for others? And he went beyond just asking a question. He ran a regression of one. So the left-hand side is 1 minus the discount. So the higher that number, the smaller the discount. He found that companies with higher revenues had smaller discounts than companies with lower revenues. Bigger companies had smaller percentage discounts than smaller companies. He found that companies which are, where you were issued, the restricted stock was a much bigger percentage of the shares, had a bigger discount than companies with that restricted stock issue was smaller. The more you're trying to restrict, the bigger the discount. Third, he found that money-making companies had much smaller discounts than money-losing companies. And finally, he found that if the person buying the shares had a customer relationship, the discount tended to be smaller because they had other side games they could make up the money on. Now, by itself, you're saying, who cares about this regression? Let's say you are in an appraisal firm and they're stuck with restricted stock. They think it's the best way to go. I would argue that this regression gives you a way of differentiating across companies. Here's what I did. I took the 25% as my standard. I said, okay, 25% is standard. I'll concede that to you. But I'm going to estimate what the discount will be as a function of how much you have in revenues, 5 million to a billion. And the larger your revenues, the smaller the discount, taking the regression and just quantifying the effect. And also what the discount would be if you're a money making, which is the purple, versus the money losing company. How will this play out? If I'm an appraiser and you're my first client, you walk in and ask you, how much revenue do you have? And you say 5 million. They say, are you making money? And you say, no, I'm losing money. The discount I'm going to attach to you is close to 35%. You're a small money losing company. The next client who walks in and asks you, how much revenue do you have? You say $1 billion and you're making money. The discount I would attach to you is closer to 15%. I now have a mechanism for differentiating across discounts across firms. Larger firms will have smaller discounts, money-making firms, and I'm using the regression as my device for making that adjustment. I don't like restricted stock studies, but appraisers love them. So if you're ever caught up with an appraiser who says, I love restricted stock studies, push them on why they use 25% for every company, because there's a mechanism for adjusting across. Now, the IPO studies, I'll be quite honest. Sometimes you look at a study and say, that cannot be right. There's something strange going on. The typical IPO studies, here's what they find. Those people, remember what you're doing. You're selling your share of a company 2 months before an offering at a price lower than the offering price. You know what these studies find? The discount is 30, 40, 50%. Let me ask you a question. If you think your company is going to go public at $20 2 months from now, would you sell your stake in this company for $10 per share? This doesn't pass the smell test, right? And when something doesn't pass the smell test, the question you got to ask is, what is statistically going on? They could commit this could be data fraud. But even without data fraud, there are lots of ways bad results can come in. And the culprit usually is sampling bias. Both these groups of studies have horrendous sampling bias. Let's take the first set of studies. The restricted stock studies. What are you doing in a restricted stock issuance? You're taking a company which has shares trading at $10 and you're issuing new shares at $7 per share. So why would I do that? Because you're desperate. The kinds of companies that make restricted stock issuances are not healthy money-making companies. They're incredibly unhealthy money-losing companies. It's a sampling bias. Let's take the IPO. Here's how these studies run. They take every company that are in public and then they look backwards in time to see whether there were any transactions in these companies. But staying on that note, does every company that announced that it's going to go public actually go public? Do some companies kind of pull back their offerings? Happens all the time. You see where the sampling bias comes here? They're starting with companies that went public and working backwards. But if you wanted to restructure this study without bias, what would you do? Take every company that announces they're going to go public, look at transactions of those companies. The companies that do go public, you will find a discount on the offering price, but the companies that don't go public, you'll actually see people paying too much because those companies don't go public, the price is going to drop. Sampling bias is deadly. It happens all the time. The next time you see a study that claims something, step back and say, is this true? And if it looks too good to be true, there's probably some sampling bias driving it. So with both these studies, there is a sampling bias, and the defense that people offer is, what else can we do? We need to be able to observe the liquidity discount. But there is a much bigger universe that you can use to check on illiquidity discounts. Let's say you buy Apple right now, one of the most liquid, highly traded stocks, and a second later you sell. You buy 1,000 shares of Apple, and a second later you sell those 1,000 shares. Forget about brokerage costs. Will you get your money back? I'll tell you, you will not, and there's a reason why. There's only one market price, you see, right? But in the actual marketplace, there's something called a bid-ask spread. Basically, the price at which you buy is always higher than the price at which you sell. In the case of Apple, that difference is tiny. It's 0.1% of the market price. But if you take a lightly traded NASDAQ stock, bid-ask spread of 2 to 250. So when you buy 1,000 shares, you pay 250. A second later, when you sell them, you get back $2. Hey, the bid-ask spread is actually an illiquidity discount on publicly traded stocks. Do you see where I'm going to go next, right? Rather than these small bias samples, I'm going to look at every publicly traded stock. It's a pain in the neck, I'll admit up front. I'm going to look at publicly traded stocks. I'm going to look at the spread on each stock. And every stock has a bid-ask spread. So I'm not sampling. I'm taking the whole universe as a percent of the price. So on my left side, that becomes my dependent variable. Then I look for things that explain why some companies, why does Apple have such a small spread? And why does this NASDAQ stock have a higher spread? The answer is pretty simple. Large companies, which are liquid and have lots of institutional investment, will have much bigger, much smaller spreads than smaller companies, which are less liquid. So basically what I did here was throw in three variables. How much the company had in annual revenues. The larger the revenues, the smaller the spread tended to be. How much the company had in cash. Why does that matter? Companies with a lot of cash are already liquid. The spread should reflect that. And thirdly, I looked at how much the company has trading volume. And the higher the trading volume, the more liquid a stock, the smaller the spread. Now, why am I doing this? Because I want to get an illiquidity discount for my privately owned restaurant. Is saying this is a waste of time. Here's what I'm going to do. I'm going to take the restaurant. Does the restaurant have revenues? Yeah, I know the revenues. I can plug it in. Does the restaurant have cash? Yeah, I can plug in a cash. And if you think of the restaurant as a private business that never trades, put in a zero trading volume, I get a predicted bid-ask spread for this restaurant of 12.88%. You're saying, what does that even mean? Given how bid-ask spreads vary across publicly traded companies, this privately owned restaurant should have a bid-ask spread of 12.88%. That becomes my liquidity discount. I'm extending the public market knowledge into the private space. And to show you the contrast, if I'd followed the traditional routes, I'd have ended up with much bigger discounts. I seriously think private companies are being taken to the cleaners in many ways. If you're doing transactions, not tax law, putting this discount, I think, is malpractice. Yeah. In fact, finally in 2007, the IRS hired an expert to look at those restricted stock studies that showed a discount of 30%. And they hired a statistical expert. And in statistics, you can actually quantify how much of that 30% comes from the sampling bias, that these are distressed companies. Turned out that 23 of the 30% that they were getting from that study came from the sampling bias, 7% came from illiquidity. We vastly overstate discounts for illiquidity in private company valuations, but their defense is everybody does it, don't pick on me, right? So in this case, the value that I'm going to get with that discount is 454,000. Yes, Max. Depends on whether you're selling or buying. Okay. If I'm the seller, you know, if as a buyer, it's great for you. So you're saying buyers will, but it's unfair either way, right? It's not a fair number. And I think, you know, but you're right. If you're a buyer, you're great, put a big discount. But as a seller, it clearly is taking value from me, of a business I've built up and transferring it to you. Okay. So that's private to private. You could see all the hoops I had to jump through, right? Lack of diversification, lack of liquidity, key person. And that's why I said it's the messiest of all valuations. Let's move to a second scenario. You have a private company that's interested in selling to a public company. Think about what goes away now. Investors in public companies are diversified, so there's no total beta. You couldn't go back to a market beta. And the illiquidity discount, not an issue anymore, because once you become part of a publicly traded company where investors can trade their shares, who cares about illiquidity? So here's the effect of doing that. First, if you look at the cost of capital that I estimated for the private to private transaction, remember the buyer was undiversified, 13.25%. That becomes 8.76% if it's a public buyer, because I go back to a market beta, and then market beta is lower cost of equity, lower cost of capital. If I take that lower cost of capital and put it through, the value that I get for the business is much higher. Why? Lower discount rate. Exact same cash flows. I'm not changing the cash flows. 2.4 million instead of 1.44 million. You subtract out debt, you get a value for the equity. Remember, the public company, there is no illiquidity discount. By the time I'm done, I have two numbers. 454,000 to a private buyer who's completely undiversified, and 1.483 million to a public company that is where the investors are diversified, they don't care about liquidity. You play the role of the seller of this business. You're the restaurant. I am a public buyer. Arc Restaurants, publicly traded company. I'm interested in buying you. You have both these numbers. One in the left pocket, one in the right pocket. Remember which number you put in which pocket. You don't want to pull the wrong number out. So so when you ask me for a price, what's the price you're going to start with as a seller? What are you going to ask me to pay? Go ahead. Well, don't get greedy. I mean, just take the public price, right? At least 1.483 million. What am I going to counter with on the other side of the table? I would say, look, you know, you can make only 453,000 out there. I know what you can make. And where between these two numbers will you end up? It depends on what you're absolutely right. It depends. Whether there's more than one potential, if there are two potential public buyers, what are you going to do? You're going to play us off against each other. You're going to end up closer to the 1.483. But if I'm the only game in town, I'll predict we're going to end up closer to 450. I'll be generous. I'll pay you 550. I will act magnanimous. You say, I am feeling, you know, we're compassionate. There's great business. You're a good business person. You see why both sides walk away thinking they won, right? As the seller, you'd have made only 450,000 from that private buyer. I'm offering you $100,000 premium over that. And as the buyer, I walk away with an extraordinary effect on value because I paid 550,000 for something worth 1.483 million to my investors. Now do you see why roll-ups done right can succeed? Because in a roll-up, here's what you do. You buy private business after private business. You might pay a premium on what they can get relative to other private buyers, but you're paying a discount on what you should be paying given the risk. At the end of the process, you have 100 rental stores or 100 waste disposal companies, Browning Ferries, or 100 pharmacies like CVS. You end up with value created in the roll-up process. So private to public, any questions? So when you look at these numbers, it always makes sense if you're a private business owner to compute both numbers. One number might be purely aspirational. You might never get there. But if you don't do this, you're going to be giving away your business for a fraction of what it's worth. Now, at least when they offer you 550,000, you know they're getting a great deal. And if you play your cards right, you might be able to push 600, you know when they will walk away. And it's definitely not going to be at 600,000. And you kind of push that to its limit. Okay. Private to private, private to public. Let's talk about private to IPO. So now you're going to plan to go public. So first, who are the people who might be buying your shares in an IPO? What kind of investors? Investors in the market. Diversified or undiversified? Doesn't matter. It's not your problem anymore. If they choose to be non-diversified, you're not going to bear the brunt. So the diversification issue goes away. What about illiquidity? You're going to become a public company. Who cares if your assets are illiquid, right? They can trade their shares. So already you can see when you value a company for an IPO, it is going to look very much like a public company. And I'll talk about the 2 or 3 tweaks you have to make. But most of the valuation is going to look like a public company. So valuation I did of Twitter on October 5th of 2013. Are you familiar with how when a company goes public, what's the sequence? First, you hear news stories that Reddit is going to go public. But what's the first official action that triggers that they're going? What do they have to do with the SEC? They have to register and file what's called a prospectus. What does a prospectus look like? It looks very much like a 10K or an annual report. It gives you all of the history of the company, and it'll give you details about what the company plans to do after the offering. If you've never seen a prospectus, I encourage you to pull down the prospectus for a company. I have the Alibaba prospectus from the time they went public. I have the Facebook prospectus, because I value these companies at the time of their IPO. So this was my original discounted cash flow valuation of Twitter. And basically the story I told was of a successful online advertising company, but one that would become a niche online advertising company, as opposed to what? The 2 big players in the game in 2013 in online advertising, and they still remain the 2 big players, are Google and Facebook. And I said, Twitter has no chance of being a Google or a Facebook because the people on Twitter are not as intense. They don't stay on for as long. So in my story, I gave them success, and I gave them the characteristics of a successful niche online advertising business. I gave them revenues of about 11 billion, margins that reflect the high margins in online advertising. But the bottom line is it looks revenue growth, margins, sales to capital look familiar. It's basically the FCFF Ginzu spreadsheet essentially applied to a private business. There's one tweak I had to do, and I'll come back and talk about this. So I did the discounted cash flow valuation. I valued the operating assets. Up till now, just like a public company. I add cash, still like a publicly. Then I add the proceeds from the offering. That's something unique to IPOs, because what happens is on the offering day when you issue shares and people buy the shares, cash comes into the company. In this case, $1 billion. That cash has to go somewhere. So I bring that cash into the process. I subtract our debt, I get a value for the equity. And then I have to subtract out options, divide by the number of shares. And this again becomes fuzzier with a private company because you're not yet public. The number of shares is still kind of in transition. We'll talk about some of the challenges there. But the real issues here are really after you've done your DCF. Yeah. Yeah, your cost of debt might, but let's face it, right? Most of the companies going public, how much debt do you think you're going to see on the balance sheet, right? Almost nothing, right? So generally speaking, that's if you are a heavily indebted company going public, a casino company going public, that might become an issue because the cost of capital use for the IPO will have to be the post-issuance cost of capital, right? Which might have a lower cost of debt and perhaps more debt or less debt, depending on what happens after you go public. So the intrinsic valuation part looks very similar, right? There's no total beta because you're valuing a company for the public markets. So let's talk about the twists that are specific to IPOs. There are 2 valuation twists. One is those proceeds that come in on the offering that I've added on as an extra cash balance. I'm going to talk about what companies can do with those proceeds because in this case, Twitter kept the proceeds on its balance sheet. What else can companies do when cash comes into a company in the offering day? What are the 2 other things they could do? One is some of the owners can cash out. That happened at Spotify. When Spotify went public and they made the offering, none of the cash stayed with the company. Sony, I think, which was one of the investors in Spotify, cashed out and left the company. Okay? The third choice you have is you can take the cash and pay down debt. We talked about debt, and let's say as a private company, you accumulated debt at high rates, you don't want them anymore. Just use the cash to pay off the debt. So three things. We'll talk about how you respond to all three. So that's the first issue. The second is often in the process of being a private company, how did you get to be this big? You went to venture capitalists, right? Not once, not twice, but maybe 7 or 8 times. Each time you go to a venture capitalist, you create a new class of shares because each venture capitalist is a different arrangement. Sometimes you offer them warrants or options. Why? To get them to invest. Now is the time you clean up for all of that crap, right? All of that stuff coming in. We'll talk about how much that was at Twitter. There are two pricing issues, which is after an IPO, usually you get priced by a banker who takes you public. That's been for a century the way companies have gone public. We'll talk about how that process is under strain. But the process usually is a banker puts together a syndicate, decides to take you public, and this is the nice part for you as a company, guarantees an offering price. We'll talk about why the guarantee turns out to be a pretty empty guarantee, but that's part of the process. We'll talk about how that plays out in pricing. So let's take Twitter and work these through, right? So first issue is what happened to the proceeds? 3 choices: taken out of the firm, used to pay down debt, as held as cash. Let's take the easiest scenario. Let's take Spotify. You raise money, it leaves the firm. Absolutely no impact on your valuation, right? It's almost like you're a conduit for the cash. So in the case of Spotify, there was nothing to adjust. The cash just left the firm. If you take the cash and use it to pay down debt, where does it show up in your discounted cash flow valuation? You no longer have that cash augmentation, but your debt ratio will be lower. Your cost of debt might be much lower. Your cost of capital might change. I don't know which direction. But if you keep the cash on the balance sheet as additional cash, you have to do what I did with Twitter, add it on to the cash balance. Your company magically became $1 billion more valuable the moment after the IPO. In VC, VC lingo, this is called post-money valuation, pre-money versus post-money. Pre-money is what your company would have been worth before the VC brought in the cash. Post-money is that value plus the cash brought in. So I looked at Twitter's prospectus, and if you read a prospectus, somewhere in the prospectus, the SEC requires companies to tell you what they plan to do with the offering. You cannot go public in the US without telling investors what you plan to do. And that's good, right? Because without it, I can't finish the valuation. Now, Twitter, it was rumored that Twitter would raise about $1 billion in the offering. You're saying, why rumored? Because this was 3 weeks before the offering. That number is still floating around. So you usually get a rough sense, billion, 2 billion. Alibaba was rumored to raise 20 billion on their offering. On the day that Alibaba went public, their value jumps by 20 billion, additional cash. But you start with that. And the prospectus said that that cash would be held in the company. So that kind of laid the foundations for why I treated cash the way I did, added an extra $1 billion. Any questions on how the proceeds get used and where they play out in valuation? So if proceed gets held in the firm, added to the cash balance. If it gets paid out to owners, ignore it. And if it gets paid to pay down debt, used to pay down debt, change the debt ratio and the cost of capital in your discounted cash flow valuation. Let's talk about the debris that have accumulated in the process of being a private firm. You had 6, 7, 8 rounds, multiple class of stock. And what have you been paying your employees with along the way if you're a young company kind of building up? Options, restricted stock, all of that crap comes to the surface at this, because this is your last chance to clean it up, right? You can't say after the fact, oh my God, I didn't see that coming. It's in the prospectus. So you have to deal with both the fact that you have all these different claims on the equity. You also have to deal with the fact that you have warrants and options out there. So with Twitter, here's what the numbers look like. Yeah, the owners of the company owned the common shares, but there were 7 classes of convertible preferred shares. You know what that tells me? There have been at least 7 VC rounds at this company. Facebook had 12 classes, which means there are 12 VC rounds. Luckily for me in this IPO, those convertible preferreds are all going to be converted to common shares. So you could basically act as if they're going to be common shares. They also had 86 million restricted stock units, mostly issued to employees as part of compensation packages hanging out there. They had 44.16 million options. Now, do you see why when people give you a share count on IPOs, you got to be very careful because often they ignore the restricted stock units, they ignore the options, and that can really make a huge difference in here. So 44 million options. The convertible preferred shares get converted to common shares. I counted them as part of common shares. I also counted all the restricted stock units as part of the common shares, even ones that had not been vested. And my reasoning is, if they're big restricted stock offerings and you have them, you're not leaving till you get vested. And if you have 1,000 RSUs and you walk out, I really don't care about you. You're not making enough of a difference. So rather than trying to attach an estimated probability, count all the restricted stock units. So this 574.44 million reflects all of the outstanding shares you expect to see after the company goes public. You're saying, what about the options? What do we do with options when we value publicly traded companies rather than count them into the share count? We value the options as options subtracted from the value of equity. So I'm going to do exactly the same thing. Right? So I do all of this. I'm valuing the company, right? You're the investment banker. What's your task again? I came to you. What's your job? You got to take my company public. You got to sell. Do you have a pricing mission or a value mission? It's a pricing job, right? I don't have a problem with investment bankers pricing IPOs. That's your job. What I have a problem with investment bankers acting like they've done intrinsic valuations and putting up a DCF. Now, I just want to go to road shows and do you really buy into this DCF or just showing it because you're meant to show it? Your job is a pricing job. And if it's a pricing job, just price the damn company. Remember how we priced Twitter, right? We looked at the number of users, we multiplied by $100, and we said, we're done. Now you have to look busy, right? You're a banker, you claim to have pricing expertise. So spend 3 days multiplying 215 by 100. Maybe try it with different calculators, multiply, reverse the numbers. Ultimately, it's going to be 21.5 billion, no matter how you slice it. If need be, create a DCF reverse engineer to give you 21.5 billion to make it look like you did a DCF. Do the dances you have to do, but your job is a pricing job. So let's say you price the company reasonably well. You offer a pricing guarantee, right? What does that mean? So let's say your price per share that you come up with, the pricing is $42 per share. Do you want to guarantee a $42 price? Think like an investment banker. Do you want to guarantee the price? It's pretty risky, right? Why? Because if you don't, this is a price. It could be 38, 39, and if you guarantee 42, you got to make up the difference. So what are you going to be inclined to do? You're going to discount the price. And the studies show that you do exactly what I expected you to do. The discount turns out to be 10, 15, 20%. You know how this shows up on the offering day for IPOs? What do you generally see happen to the stock price? It jumps from the offering price. How much? Twitter doubled on the opening day, which tells me the banker did a really screwed up job pricing the company. Maybe the $100, you might use 50 instead, or maybe didn't even price it, actually did a DCF. Yeah. But on that offering day, this is the percentage jump in the stock price. The typical IPO is underpriced by about 15, maybe even 20%. Now, if you're an investor, you're saying this is a great way to make money, right? So Warang, how would you take advantage of it? You're an investor, you've seen this study, you want to create a mutual fund to take advantage of this finding. So what's your mutual fund going to do? Take every IPO, apply for 1,000 shares, right? And you should make this great money. People have tried, it never seems to work out. So tell me why that strategy doesn't work out. That's a timing issue, right? So even without the timing issue, even in good IPO times, it doesn't seem to work out. So let's say you have 100 IPOs, you ask for 1,000 shares in each of the IPOs. You might get the 1,000 shares in 7 of those IPOs. And guess what? These are the 7 you didn't want to get 1,000 in because you got them because the demand was too low. So you get your full allotment of all the bad IPOs. And of the really good IPOs, when you ask for 1,000 shares, even if it's a fair allotment, you get 325 shares, 275 shares. Your weighted average doesn't look like this study. It looks like it's weighted more towards the worst IPOs. So in practice, you can't make any money on it, but it is there. In fact, when people first uncovered this underpricing of IPOs, they called it the IPO puzzle. The first puzzle was, why aren't investors taking advantage? And the answer was very simple. It's not easy to take advantage of. But they raised the second question, why are issuing companies okay with this? Do you see why let's say you built up a great company. It's now a $10 billion company and you plan to go public. I'm the investment banker. I take it public at $8.5 billion. Should you be a little pissed off about this? Right? No, the market is willing to offer me 10 billion. This can't be blamed on market dynamics because the day of the offering, it goes, is offering me a high, so why not skip the banker and go directly to the market? Yeah. This is a psychological reason. You know what? I'm still pissed off after the fact. Now, the day the stock price, there are companies that said, well, on the offering day, the price doubles. I am lying in bed saying, what did you guys do? No, but why? There doesn't seem to be that much of a pushback. Yep. You know, on an offering, because it's not even publicly traded, you can't do a block transaction because you need a block buyer, right? An offering day, there is no real chance to do it. You're going to get the discount. What did I describe the company as? 10 billion, 15% discount. You're leaving $1.5 billion on the table. But is that the case? What exactly do you lose on the offering day? If I'm selling only 10% of the company, it is a 15% discount, but I'm leaving only 150,000 on the table. I am. But in return, what do I get? Great press stories, right? The next day, what does the Wall Street Journal have as a headline? XYZ company jumps 40%. And what happens? People read that. And then what do? They go buy and they push the price up. You've heard of loss leaders in stores. Loss leader is something, it's in the front table. You come in the old days in your brick and mortar stores. Say, that's an incredible scarf for $1. It's well below cost. And it's almost like they suck you further and further into the store. There's table after table. And by the time you get the seventh table, you're in the Ralph Lauren section paying twice what you should be paying. And they've covered all their loss leaders. You see why founders of companies are okay with this discount. Because they're not selling their stake on the offering day. They're planning to sell it. Often there's a lockup period. You cannot sell your offering. They're planning to sell it 6 months later, a year later. They're hoping. They're praying that this offering day buzz will continue. It might not, but that's what you're hoping for. So, as an investor, you're saying, why didn't I take advantage? The answer is you cannot. The allotment process takes care of it. But in terms of the actual discount, the reason issuing companies are okay with it is if this were 100% offering, issuing companies would probably push back more. If it's 7, 8, 10%, they'll push back less. So I'd like to show you a graph that's not in your notes that I've added on. So the new version of the slides actually has this. I actually took a look at what's changed about IPOs over the last 40 years. So basically in 1980, if you look at a typical company going public, it had revenues of about 50 million and almost 90% of companies going public were money-making companies in 1980. Take a look at the last decade. What do you notice? Much bigger revenues. The typical company going public in the last decade has 10, 20, 30 times the revenues of companies going public in the 1980s, even with the inflation adjustment, that jump. And only about 20% are money making. The typical company going public in the last decade is a much bigger company, but more likely to be losing money. What do you think is happening here? Something clearly is changing, right? Probably tough to remember, but you go back to 1980, you know what a typical IPO looked like? It looked like Apple going public in 1980. It's a small company, but it's a money-making company. And why did Apple go public? Because they'd run out of venture capital rounds. Basically, venture capital was not big enough to keep sustaining them. And in 1980, if you wanted to get bigger, you had to leave the venture capital space. You had to go public. So what's changed about the process where that's no longer true? Because clearly something has changed about the process. Sebastian, you want to try? So one is VCs have become bigger. Let's say come like Uber, right? It stayed private for like 12 years. Every year there'd be a rumor, oh, it might stayed private. But as it went along, even though it got so big that VCs couldn't fund it anymore, who was investing in Uber in 2014 and 15 and 16? Private equity initially, but it went beyond private equity. It went to the Saudi sovereign fund and Fidelity and T. Rowe Price. Public investors were investing in Uber, even though it was a private business. It's almost like in 1980, it was private companies on one side, public companies. There was a divide. Now we've created this gray space in the middle where private companies can stay private, have access to essentially public equity without any of the consequences, right? No disclosure requirements, no corporate governance. Why would you want to go public? Stay private, collect billions of dollars. The disclosure, the monitoring is much weaker. Eventually, what makes them go public is VCs get tired of waiting. But the typical company going public now is bigger. It's allowed to scale up, but it doesn't have a well-formed business model. And I think this is disastrous. It's disastrous, not just for investors, right? But in terms of the consequences. We're supplying companies with half-baked business models with tens of billions of dollars to do what? To go out there and change the world. You know, when did disruption become a good word? I mean, I remember when I went to school, there were disruptors in the classroom. You know what happened to them? They eventually ended up in jail, but along the way, they're not 6, you can't send them off to jail, even though some deserve to be in jail that early. Now, 6, you put them in the corner, put a dunce cap on them. I went to a very primitive school. They actually put a dunce cap, a paper cap. You had to face the corner, right? At 10, you went to those are the kids who went to the principal's office. Why? Because disruptors ruin it for the rest of us, right? Somewhere in the last 15 years, disruption became this magical word in Silicon Valley. I'm a disruptor. Congratulations, amazing. My reaction is go sit in the corner, look at the wall, put a dunce cap on. But we supplied disruptors with money to do what? To disrupt. Disruption became the end game. And I think we're going to pay the price for that. I mean, Uber was a disruptor, right? Or did it disrupt the taxi cab business? We supplied tens of billions of dollars. Let's say that ride sharing is just a terrible business model. It'll never work. And Uber and Lyft both go bankrupt. We are screwed. How the heck are you going to get from the airport back home? You say, I'll take a taxi cab. There aren't enough of them anymore. You'll have to walk from JFK to Manhattan. We've created a world where we've ruined the status quo because we've supplied disruptors with billions of dollars of capital. And we have these business models that are half-baked. So I'm going to, and in fact, if you look at the actual IPO process, this goes to the point, on the offering day itself, the percentage of shares being offered has become lower and lower. In 2022, this number was down to 5%. The typical offering day, you're basically getting a sampling of the shares. That number used to be 20, 30% in the 1980s because people actually raised capital on the offering day. So I'm going to end today with talk about how we go public. For a century in the US, the way companies went public is they went and found an investment banker. That investment banker created a syndicate. And that syndicate set an offering price, and then we played this little game. But let me step back and say, why did investment banks become such a critical part of the process? So I think of being a small company 50 years ago, and you were going to go public. What did the investment banker do for you? What are the services they offered that made you think you needed them? I'm sorry? First is you have to sell it. So even before that, first you said, I don't know how to price a company or a founder of a tech company. What did bankers do? There's a lot of, SEC filings you got to make. And also you got to price the company. You've never priced a company. Bankers are experts at pricing. That's a delusion people operate under. So you offered pricing, you offered this paperwork services. Did they do selling too? The whole point of having a syndicate is then they would call clients, the old days, get on the phone and try, so they're selling services. And then they also offered what were called post-market service, which is after you went public, they would actually offer pricing support. If your price dropped, they'd come in and buy shares. You're seeing such generous people. In return, what did they get? You raised 100 million, 8 million of that went to the investment banker, 10%. And that was the compact that worked for much of the last century. I think that compact is broken. Who thinks bankers can price anything anymore? We know how we have conclusive evidence that they cannot. How can a price jump 50% or 100% the offering, Dave, you're doing? So they're not very good at pricing. In addition, in the old days, if you are a no-name company, you use Goldman Sachs because Goldman Sachs gave you credibility, right? Today, attaching Goldman Sachs to your name might actually reduce your credibility. 2008 kind of screwed it up for all of us because he said, hey, these investment banks, they're kind of shady characters. You've got a shady front. I'm not buying your shares. So the credibility effect is gone. The pricing is non-existent. You see, what about the selling? Who buys shares because a banker calls them anymore? You buy shares because you see it mentioned on Twitter and somebody else is buying it. Social media, I would hire, social media celebrity to sell my shares rather than a banker. Be much more effective. If you can get Taylor Swift to mention my name, think of how much, more I will get per share. The selling is not there. You think, what about the post-market support? Bankers don't have that much money. If your stock is dropping 10% every hour, there's nothing a banker can do to stop it. In short, nothing that bankers seem to offer services with much value. And why are you paying 8%? So one of the things you started seeing is that 8% has become 7 and 6, but people have also started asking the question, is there a better way? And there are two alternatives that have come up. One is what Bill Gurley suggested, which is he said, why do we need a banker? Why don't you make a direct listing? What does that mean? You don't set an offering price. You open it up to demand and supply, which is what eventually happens anyway. So rather than have this, have an open, that offering day, let the market set the price, which it does anyway, but nobody walks away with a windfall because they got the price. The only problem with direct listings right now is the SEC restricts the cash you can raise in a direct listing. You can't keep it, you have to pass it through. Okay? The other is this absolute monstrosity called a SPAC. What is a SPAC? I am a celebrity investor, not even a good investor, a celebrity investor. You've heard about me and you think I'm a really good investor. Let me put a name, Chamath Palihapitiya. This guy creates a SPAC every 15 minutes. Okay? You've heard of me. You've read, I have a big Twitter following. You've heard of me on social media. I start a SPAC and I ask you for your money. Why? Because I plan to invest in a company that I'll go public, which is unspecified. This is like a trade for a person to be named later. It's a IPO to be named later. You put your money with me. Why? Because you're greedy. You think I'll find you great deals. I collect your money, and here comes the nice part for Chamath. He takes 20% of that money right off the top. And then the remaining 80%, he goes on a search mission to find a company to take public. A year and a half, he said, why haven't you found one? I'm still looking. And eventually takes your company public. This is a horrifically bad alternative to banks. But there's a way in which SPACs can be modified. Bill Ackman created a SPAC. Instead of taking 20%, he took 5%. So there is a way you might be able to save SPACs, but not in the way it's structured now, where every grifter on the face of the earth with a name that is recognized can go out and create a SPAC. This is probably going to get back to Chamath. He's going to tweet about me. I frankly don't care. No. But next class, when we start, we are going to continue. This is the last piece of this is the total beta we said reflects how diversified an investor is, right? Think about a typical business. You start with the owner having all the capital. VCs come in year 2 and you go public in year 5. Do you see what that means for your cost of equity? For the first 2 years, you're going to use a total beta. In years 3 to 5, you're going to use a VC beta, which is going to be lower because they're more diversified. And in year 5, when you go public, you're going to use a market beta. Your cost of equity is going to change because your marginal investor is getting more diversified. So after the quiz on Monday, we will start on packet 3. There is a packet 3. If you think we're done with the class, think again. We have a packet 3. We're going to talk about real options and acquisitions and value enhancement. But I will see you on Monday. Incidentally, I have to go to Brazil tonight, and I'll be back on Saturday. But on Sunday, I will have office hours. So I'll send you the timing for the office hours as well. Yeah.